LBR LBO Infrastructure Summit 2016.
Hi, good afternoon. So I've now got the not only competing with the fact that everybody's not had their tea, but I've also got to follow the advertising guy. So
Branding guy. I don't do
sorry,
advertising.
branding guy. My apologies. So I'm going to be tackling the topic of ease of doing business and facilitating capital flows. I thought starting with the World Bank's ease of doing business rankings would be a familiar benchmark for most people in the room. Since 2009 and the end of the conflict, Sri Lanka has made progress in terms of the ease of doing business index. However, this has not always been a linear progression. The 2016 ranking for Sri Lanka improved to 107 from 113 in 2015, but if you look back to 2013, our ranking was 83. Admittedly, there have been criteria changes to the ranking, and it is not a perfect system, but rather a guide. And yes, it is a limited indicator, but it is a benchmark and a report card which enables us to understand the areas that investors evaluate when making investment decisions across different geographies. You have to remember that we live in a highly competitive global market with stiff competition to attract capital. Sri Lanka does not have the advantage of a large domestic population like our neighbors, India or Bangladesh. Neither do we have the natural resources of an Indonesia or Myanmar. Therefore, we have to focus on leveraging our geographical location, creating access to larger markets on preferential terms, developing a skilled, productive labor force, and creating an open, flexible environment for new, innovative businesses to set up and invest in Sri Lanka, and especially in this proposed Western region agglomeration. I think there are certain fundamentals to attracting capital and creating an environment conducive to doing business. For one, a strong legal system with clear enforcement of contracts is key. Sri Lanka has the advantage of English law being our basis for commercial law, but we have to improve the time taken for litigation, which currently averages around 4 years. Banks and companies require legal recourse in a shorter and more effective time frame to provide investors with greater confidence. Another factor would be a simplified tax code. Sri Lanka has made progress in this area, but I think it is universally recognized that our tax system needs to be improved in order to deliver clarity and simplicity for implementation and collection. Retroactive taxes and a complex system with several layers of taxation and varied tax thresholds for different industries is a negative for investors who have to then decipher this code prior to making their decisions. Clarity is really king. Red tape and regulatory approvals, as we know, are impediments to facilitating investment. Although Sri Lanka is better than most of its peers in South Asia on this front, we need to improve significantly to get to the benchmarking of Southeast Asian nations and certainly city-states like Singapore or even Dubai. The government's ability to streamline processes for regulatory approvals will greatly encourage and enable investment and capital flows in the future. Investors, I'm sure many of the panelists today, as well as earlier today, would have talked about the requirement for a one-stop shop to set up and secure all the necessary approvals for their businesses. The ability of an agency like the BOI or a mega agency to facilitate faster and more efficient establishment of businesses enables greater FDI flows, not just for projects in the hundreds of millions of dollars, but smaller scale investors as well. One of the overarching themes for investors, both local and foreign, is policy consistency and clear early articulation of policy. We have seen on several occasions the stifling impact of slow communications of a new policy, or worse, a policy U-turn. The revival of Underperforming Enterprises and Underutilized Assets Act in 2011 was viewed externally as government nationalization of private assets, undermining the sanctity of protections provided to investors under existing laws, including the BOI Act. Retroactive taxes, such as the super gains tax, implemented in 2015, and the taxation implications of the Land Restrictions of Alienation Act of 2014 hurt investor confidence and the appetite for future investment, given greater uncertainty and their ability to plan and predict. Capital flows to where investors see consistency in long-term policy and have the confidence that they are able to plan beyond the immediate. The success stories of economic emergence in countries like Turkey, Thailand, and Korea come from a foundation of implementing progressive, long-term liberal economic policies. What we're really talking about is facilitating large-scale FDI. And this will require the political will to implement more liberal economic policies. For instance, if we look at the corporatization of SOEs with a view to increasing public-private partnerships and potentially the privatizations or listing of SOEs, increasing stakeholder ownership to a wider demographic via local institutional investors and even retail investors. This should enable better allocation of capital to transformed SOEs, which are more efficient and then will compete in the private sector. Our equity capital markets would be significantly boosted from a pipeline of large-scale IPOs, such as the likes of SLIC or one of the state banks, or any of the state banks. The pipeline of such privatizations was a key factor in the development of the capital market in Vietnam and attracting top-tier institutional investors. I also realize at the same time that this is a very politically sensitive subject. We should also look to creating a robust local currency bond market supported by larger institutional investors, such as insurance companies and private pension funds. This will help to facilitate access to longer-term rupee-denominated capital, both in terms of debt and equity. One of the learnings from the East Asian financial crisis of 1997 was that an over-reliance on foreign capital, especially very liquid short-term capital, could be problematic when there are economic shocks and an open capital account. Saying that, the potential relaxation of capital controls is something that we have to look at and would be a great enabler for inflows of capital, as businesses find it easier to participate in cross-border transactions, especially trade. The ability to freely move capital also removes a potential reservation for investors when considering investments in Sri Lanka. We need to look at being more innovative in terms of the development of asset classes for investment. Currently, there are discussions that revolve around the potential for instruments such as REITs and ETFs, and it is important for financial institutions to provide innovative products and develop such markets, while the regulator will look to ensure transparency and investor protection. However, especially if we look at the example of REITs, there should again be policy consistency. If there are restrictions on companies deemed to be majority foreign-owned, and these are restricted from owning and developing land, then REITs would be certainly compromised and limited. Sri Lanka has to consider not only opening up investment capital flows, but also human capital flows to help facilitate the former. We already face skilled labor shortages in several sectors, ranging from construction to leisure. The inflows of labor is something that will be viewed with suspicion, as is the case in most economies, whether they are developing or developed. However, as much as our economy has been sustained by the export of labor, we now need to attract labor into this country. I think the development of a mega conurbation in the Western region, especially with the development of a wholly planned new city such as the port city, provides an interesting and exciting opportunity to attract capital. But as always, the proof will be in the implementation of this plan.
LBR LBO Infrastructure Summit 2016.